Good evening, everyone. My name is Kamal Manocha. I represent PMS AIF World. We come with another webinar on this Friday evening. Over last more than a couple of years, over last 3 to 4 years, we have seen a substantial rise in the space of alternates, and that also has given a lot of name and fame to our platform. Our timing of starting our platform, PMS AIF World, was quite thoughtful, and this is exactly what has led to very deep discovery of various insightful alternative investment products, especially for HNIs and ultra HNIs. And in line with that, the space of mutual funds over time is actually kind of becoming more retailish, and regulators are also contributing to the same. The recent move has been in the month of March of 2023, where taxation of debt mutual funds was changed forever, and the long-term capital gain tax benefits in terms of indexation were taken away. Also, over years, we have seen regulator has been kind of coming up with more and more robust regulations in the space of alternatives, which has made this space quite attractive and appealing to HNIs and ultra HNIs. And that is something which makes this space now very meaningful. Hence, we are all the more confident and we are all the more energetic to present on every Friday to our audience of HNIs and ultra HNI clients as well as investors about any new and good products that we like. So this particular webinar, we will be covering particularly on a product. We generally, do webinars to talk about a thought or concept, but in this webinar, we're going to talk about a product. But before we, get into that discussion, we'll understand the genesis of this product, the history of this product, because this product comes with a track record of 3 such products already running in the past, which have actually done really well. And this is basically a private credit kind of a product in the category 2, whereby the real estate backed lending is done. I have Mr. Karthik Athreya, who is the head of alternative credit in Sundaram Alternates, as a speaker today. He is the fund manager behind this product, and he brings with him 22 years of pertinent experience. Before we get on to discussing about this particular product, we want to understand from Karthik what are his views, in the context of the rise of alternatives that we are seeing, especially in the category 2, in terms of the opportunity, the potential, and the challenges. Warm welcome to you, Karthik, to discuss this in this webinar. We'll be discussing, a lot of aspects with regards to private credit, as well as the, minute aspects with regards to this product. But let's, first generically understand from you what are your thoughts in this regards.
Sure. Thank you, Kamal, and thank you to PMS AIF World for giving me and Sundaram Alternates this opportunity. Am I audible?
Yes, absolutely. Loud and clear.
Okay, great. So I'll start with the leading question that you asked, which is, the rise of alternates, and within that private credit. Alternates is a very ambiguous and large word. There are contexts to this word globally, and there is a, as usual, customization of this as far as India is concerned. But essentially, alternates is really an investment or a set of investment avenues, in my definition, which are not historically either part of public equities, or the typical mutual fund products, or even fixed income, low level return products like fixed deposits and so on. And these are different asset classes where there are opportunities for investors to put in reasonable amounts of money and make better than what are deemed as benchmarks returns in those particular asset classes. So in the Indian context, the AIF, or the Alternate Investment Fund regulations, came into being close to about a decade ago. And from then on, the industry has really effectively, if you take out the COVID years, has had about 8 years or so to grow. And so the whole span or suite of products which are there in AIF category 1, which is for impact funds and so on, AIF category 2, which is there for private credit and for private equity, and AIF category 3, which typically have listed products, but those are not typical long short and so on, but those are typically quantitative derivative inputs and so on, which may have listed instruments, but which are typically corollaries of bets that you take vis-a-vis the market. And within this, there have been numerous fund managers who have spawned in each of those categories to create deep, strong, sustainable set of products and sustainable set of fund choices, which is really the trigger for the industry as a whole. So, any industry will emerge and will grow only if the customer or the investor has choices, and he or she has over the last 8-10 years developed a range of choices coinciding with the period in which India is growing. One can argue whether it is growing at 2% or at 8%. The fact that it's growing in a growth economy, when you have a new set of asset classes, which typically will not find investment avenues, through public exchanges, public marketplaces, and so on. And these are privately distributed fund vehicles. There is bound to be interest, and that is really the emergence and the trigger for the industry. Just anecdotally or statistically, the industry that I'm talking about has grown from zero to over $85 billion, close to 6.5 lakh crore rupees has been raised in just category 2 funds. And if you add category 1, category 3, that number is probably closer to 150 billion, which is a pretty sizable piece of, even if you take Indian credit markets as $2.5 trillion, it's a pretty sizable growth and a substantial piece of, I would say, even if you take the credit side, a non-bank type growth. So the other big trigger for the growth of private credit, which is what Sundaram Alternates and particularly myself operate in. Of course, Sundaram Alternates also has AIF category 3 equity, listed equity options, as well as the PMS business. But talking about private credit, which is really the real estate and the corporate credit side, the 6.5 lakh crore or 85 billion, is, I would think, a very healthy reflection of the fact that banks are slowly but surely moving away from all kinds of risk end use lending to particular or plain vanilla type lending, which are typically the term loans and the working capital kind of things. And all risk capital is actually moving to get funded by private credit funds and alternate funds like ours. So that is another big trigger. And to your question, Kamal, on the debt mutual fund taxation, this has really been, I would say, one of the many triggers for the accelerated growth of the alternate investment fund allocation. So we've seen in our own investor base of high net worths, ultra high net worths, family offices, insurance companies, corporate treasuries, and so on, where earlier on or 5 years ago when we started this business, if they were to allocate 1 out of 10 crores into such products, today they're allocating 3 out of 10 crores into such products, simply because they've seen the scale of the industry grow. They've seen the number of managers proliferate. They have a lot more choices as investors in terms of choosing which asset class, which sub asset class, which manager, what investing style, do I prefer considering my risk reward appetite and so on. And so from that perspective, the industry itself as a base and as depth, has grown. And the debt mutual fund taxation has added one more trigger in terms of this allocation acceleration, where investors believe that, look, if I had the benefit of long-term capital gains and tax benefits out of the debt mutual funds, and I was making 7-ish% return, and today I'm no longer going to be able to make that 7-8% return, that actually goes down to 5.5, 6. And so I need to compensate that 200, 300 bips by going into an asset class that is actually delivering those sort of returns or better, is really the way investors are looking at it. So typically in any investment portfolio, people will have elements of debt, equity, and real estate. So today, that allocation within the debt piece has started moving from debt mutual fund to perhaps AIFs, and within that, of course, there are a whole bunch of strategies that are available. So I would say, in summary, it's a very good starting point for our audience to understand that this is a large industry. It's growing at 30 to 40% a year. It's already in excess of $100 billion. It's likely to go to multiples of that over the next 5 years, in our opinion. And this is a very sustainable sort of investment or asset class avenue for investors to look at in terms of allocating capital. Of course, this is not for the extremely retail investor. So because there are SEBI mandated minimums in terms of investment capital that needs to be allocated. So for example, any of the AIF funds will require a minimum of 1 crore rupees as investment into a fund. So, this is usually meant and, benefiting investors who can contribute or commit that extent of money. So from that point of view, this is really the root and the crux of Sundaram's own business plan, where the AMC, which was, which continues to actually run equity and debt mutual fund schemes, felt 6 years ago that, they should actually be early entrants, into the space of AIF and alternates and private credit. So we set up Sundaram Alternates as a subsidiary to the AMC to actually move the PMS and the AIF businesses into it. Today, as we speak, we are in excess of 5,000 crores of assets under management. Within that, roughly, 40%, is the private credit piece, which I am a part of. Also, we've developed a pretty strong team in terms of 3 fund managers and a whole host of analysts and support staff who are helping us build this business profitably. And as Kamal mentioned, we have 2 products currently underway in the market from a private credit standpoint. The first is a real estate credit fund, where I will explain this in a minute. But in a high level, this is a fund that lends to real estate projects and largely residential self-liquidating projects. We are currently in our 4th fund of this asset class. As Kamal mentioned, we raised 3 earlier funds. And in the first fund, we've returned capital. Second fund is fully invested, as is the third fund on the verge of being fully invested. So we're launching our 4th. We've raised close to 1,500 of capital. We've deployed, with the benefit of recycling, in excess of 2,000 crores. We've done over 40 transactions, so 0 credit delinquencies. We have a pretty interesting product in terms of fund and product structure for investors, which I'll explain in a minute. We do not invest in InvITs, but that's not preventing us from doing so, but I'll take questions in the end. And our second product is a corporate credit fund, which we launched in July last year, late July, where we are also currently raising money. That is the first of the series of the corporate credit fund, which does non-real estate. But a lot of the investments are, we're trying to mirror our underwriting philosophies, between both the product features between real estate as well as corporate credit. From a product perspective, senior secured. So essentially, we lend only against hard assets, 1.5 to 2 times cover. We do only amortizing loans, which means that every quarter we get interest back, much like a bank, which we 100% distribute to our investors. We do only amortizing loans, which means that, effectively the risk gets reduced every quarter, and as each of the deal pays down, we don't do any back-ended structures of pay when able, redemption premium, correlated to equity performance, project performance, and so on. So ours operates purely like a plain vanilla debt, where we lend against security, we lend against cash flows. We enter purely at a stage where projects are working from a brownfield perspective, so we have high visibility of cash flows. We lend against multiple projects, which means we don't take single project risks and so on. So essentially, super senior secured sole charge on assets, along with the frills of promoter guarantees, personal guarantees, corporate guarantees, share pledges, financial covenants, everything that you can imagine we will have in our documents in terms of protecting our investors' capital. So in this fashion, we've consistently been able to generate between 18 and 20% returns from the deals that we've done in the market. We largely focus on the south of India, which is where Sundaram as an organization and as a franchise has largely been present. So effectively, in the case of real estate, our principal lending geographies are Chennai, Bangalore, and Hyderabad. We do off deals in Cochin and Coimbatore, but essentially stick to the south belts where credit influence presence on the ground is very high. So, and within these markets, we've generated 18 to 20% on senior secured basis. Investors have made between 15 and 17% gross returns in their hands. So on a post-fee basis, they've ranged between 12.5 and sometimes even 15%. So as you can see, even at 12.5 pre-tax return, these are substantially higher returns versus typical fixed income benchmarks, of 7 and 8%. So essentially 400 to 500 bips, in excess of where I would say typical fixed income benchmarks exist is where we've been delivering. And bear in mind that what I'm talking about is a track record over the last 4-5 years or 5-6 years, where we started when demonetization was at its fag end. Then we went through the impact of RERA, which is the Real Estate Regulation Act. Then we went into GST and its working capital impact. Then we had the NBFC crisis following ILFS's collapse and the drying up of the refinancing market. And then we had 2 COVID waves, and more recently, the inflationary environment, that impacted operating costs and cost of input materials and so on. So through all of this volatility and lockdowns and industry being on moratoriums, etc., we've consistently been distributing income and cash every quarter without missing a quarter from when we began the funds in 2017 to date. So roughly, this is also the reason why 40 to 50% of our investors are repeat investors in every single one of our funds. And essentially, we found a way to sort of templatize the real estate business and make it more of a corporate lending product where we seek to address both sector level risks as well as credit risks in a manner that consistently pays down our investments. So this is sort of the overall philosophy. Within this, obviously, we focused on within developers. We focus on developers who are, I would say, performing sort of developers. So we don't look at new entrants, nor do we look at rescuing or distressed situations. We look at guys who've largely been performing, who Cat B, but Cat B only by virtue of their scale and not by virtue of their presence or their track record and so on. So our own credit policy has criteria where at least 1 million square feet should have been delivered, before we actually lend to these guys. So we're not going to be lending to situations where there are risks, where guys have defaulted. These are people with clean credit histories. They've not defaulted in the past, and so the only end users to which we lend to are largely situations which banks cannot address. This entire real estate business is driven by the fact that there are regulatory constraints on banks from funding certain end users, from coming or going beyond a certain threshold on their balance sheet, which I think is 5% of a bank's net worth and so on, where banks can only lend towards construction financing as an end use. So situations where there are cash flow mismatches on projects, last mile financing requirements from a liquidity standpoint. You need to term out cash flows by taking out an existing lender and giving a construction financing for the balance, which is completion financing. So these have typically been the sort of end users to which we lend. So we don't do anything, which is equity in nature. So for example, we don't come in and finance land in any big way. I think there's a very minimal amount, I think 15 to 20% of a fund that may as an end use go into a land. But even in those cases, our takeout or our repayment is on the back of projects that have already been launched, already selling, where there's visible cash flow. So essentially we securitize receivables and running cash flows of projects, give money with a little bit of flexible end use towards needs that the business or the project may have. And for that, because we are coming in at a situation where banks cannot lend, we are able to charge a premium. And usually the promoters will write 3 to 4 year deals with us, which are on an amortizing or average maturity basis, 2.5 to 3.5 years. But they believe, and rightly so, that this capital at this cost should not be held for a long period of time. So in over 80% of the cases, we've gotten back money in 2.5 years. So that's usually the average tenor for every one of our transactions. So actually it's a sort of a self-risk mitigating business where we look at opportunities to be able to go into projects which are already brownfield and securitize against multiple cash flows so that you can get money back faster. And so we are able to recycle the principal portion of what we get back within the fund duration very, very effectively to get some turns of capital. So from an investor perspective, we are still able to make decent multiples of invested capital while at the same time generating annuity type IRRs for our investors, as I said, between 15 and 17 gross and between 12.5 and 15 net. So I think I see a whole bunch of questions popping up on the right side of the screen, which is I'm not able to find a way to minimize that because I'm constantly looking at those questions as I go through my dialogue.
Sure, no worries. I'll cover these questions. I have kind of gone through most of them. So foremost, basic question that mostly investors ask is that why is it that and how is it that you are able to find out some of these borrowers who are credit worthy and at the same time, wanting to borrow money at such high rates?
Sure. So I think it's a good question. And so as I said, this is fundamentally a regulatory arbitrage business. So it doesn't mean that because these guys are borrowing money from us at 18, 19%, they're not able to borrow money at 12, 13%. So there are situations in a particular project where there is, let's say, an existing lender who has come in at a fairly early stage. He or the bank has provided construction finance, but the project has actually gone through some delays in the past, but at the moment is actually generating cash flow. But effectively, between the cash flows that the project generates and the amortization schedule of the existing financier, there is a mismatch. So we come in those situations and take out the existing lender fully, and are able to stretch our repayment over a period of time that it coincides with what the project's cash generation is. So effectively, that is in financial terms called a refinancing plus a term out. And in addition to that, we provide growth financing in terms of construction to complete the project. So this is a large proportion of the deals that we do. So there are other lenders on other projects, and I saw a question of, do you do pari passu? We do not do pari passu. We are sole senior secured encumbrance holders on the projects that we finance. So if you went to a sub-registrar's office and did an encumbrance search, you would find a Sundaram fund as the sole holder of that EC, in that particular project. But having said that, the answer to your question is that we're able to charge those premiums for a limited period of time where that money is needed to correct something on that particular project, right? So this catalyst or project correction happens fairly quickly, and the project becomes refinanceable by a lower cost finance. It might have to take a money back in 1.5 to 2 years, which has happened in many of the cases, or the project itself starts generating a good amount of cash. So the promoter is actually accelerating and prepaying our loans down. So we find that this is a very interesting place or piece of the cap structure or the evolution of a project to finance, because the risk mitigation happens automatically by virtue of the underlying projects working, and we only, and this is a significant portion because I saw execution and a few other questions. So we come in, it's very important that our fund USP is two significant things in the market vis-a-vis many of the real estate financiers in the market, and all of whom do have their own individual interesting style to play the sector. But our Sundaram's view is to be in a position where you take a pure credit risk, which means we don't come into a situation pre-approvals at all. So if you see real estate, you step back, there are two fundamental risks in all real estate projects. The first is that you come in too early. So you come in at land stage, or you come in pre-approvals. So, effectively you face issues on account of the land not being fully aggregated. Now there are cash portions, which usually happen as payments. You don't know how much is equity in business and so on. Then, you have risks of political interference because if governments change, something else changes, and then, you have projects starting to get delayed. And then you also have the approvals itself, getting delayed. On an average, Mumbai, for example, goes through 40 plus approvals. Chennai goes through a little over 30 plus approvals. Bangalore goes through again 34 approvals. So effectively, even if a few of this, like important things like environment, etc., get delayed, so effectively it delays the whole project, and for no fault of the developer, that investment is stuck. So we decided that as part of our underwriting and risk management policy, we will not deal with any of this. So effectively, Sundaram comes in only post approval, which means we enter a project brownfield when it's already generating some level of cash, it has already had some level of sales, it is already constructed to a certain extent. So effectively, these are situations where either the promoter has put in enough equity and gotten the project to this stage and he's looking for some financing, or as I said before, there is an existing financier who's helped the project get to that stage, but that cash flow mismatch is potentially hurtful to that particular financier. So the developer, being a guy who in our case typically hasn't defaulted in the past and so on, who cares about his reputation, will come to somebody like us and say, help me refinance an ICICI or Edelweiss or whatever else, because they've come in early and the project is at a stage where it's working well, but there is a cash flow mismatch where I'm not able to keep payments to them with the current trajectory. So you come in and give me financing to take them out and adjust your repayment schedule in a way that coincides with the cash flows from the project. So this is a significant nuance that we do, and it's honestly difficult where we get into situations where it's only post approvals, because effectively people think that it's so de-risked as a project that it's hard to find. But the good news is that we're now on our fourth fund, doing the same thing, and we don't have any stylistic changes from fund one to now. So we've established ourselves in our local micro markets, and developers have that comfort with us that these guys are partnerly, they've been with us for a while, we've done repeat financing, so they come to us and find it easier. As a franchise, we've built that. The second key risk in real estate is the risk of sales. Everybody knows this. So essentially, if a project is not selling despite the best of intents, then investment is impacted again. So what we do to mitigate this as part of our underwriting policy itself, and this is not deal specific, this is on every deal. Every single deal we do has to be secured by a minimum of 2 running projects, which means if the sales slows down in one project, the other project sales kicks in and pays us down. So effectively, this is a little bit of the best of both worlds, where we come in post approvals in brownfield and we have multiple projects securing each of our loans. So our security structure also, remember, is not just mortgage on the undivided share of land and project and so on, but it is also 100% escrow of the cash flows out of that project. So we are considered under RERA as a project lender. So effectively, all cash that goes into the RERA collection account is split between us and what the construction requirements of the project are. So, effectively, we are able to sweep cash flows coming from the customers directly into our sweep accounts and to pay ourselves interest and principal every quarter. So that's how the significant portion of the risk mitigation happens. And by virtue of the fact that we don't do any back-ended deals or, pay when able structures and profit sharing and so on, which then, could pose risks that, cash gets accumulated, it goes away somewhere else into the enterprise of the company. We keep pulling down and paying ourselves down every quarter. So there is a reduction of risk that happens every quarter. And also, because of this, we know very, very early in the game, if there is a problem, God forbid, in the project, we know very, very early in the game, and we don't discover this halfway through the fund or halfway through the deal. So in a situation where, we're doing an 18% deal where we have 15-16% coupon, in year 3, in a 4-year deal, we've collected 3 years of coupon, and after 12 months, every quarter, we're actually starting to amortize equally. So in, let's say, 2.5 years, on a base case basis, we're anywhere between 45 to 70% collected on the transaction. So as the deal sort of progresses in our math, the cover goes up for us and the risk comes down. So that's the way the design of the funds is, that every quarter we get paid down a significant portion of the return, and that is 100% distributed to our investors. So the investors are also seeing that in a locked up product of 5 years, they're seeing every quarter that there is a liquidity that is coming into their account. So this is very, very attractive for corporate treasuries, insurance companies particularly, and family offices which are looking for annuity type investments. So effectively, the interest is paid from the first quarter in which the money comes in. Obviously, it takes in a new fund some period of time before the whole portfolio is built, for the full impact of that interest on a fund level basis to flow through to the investors. But whatever interest we collect, whatever fees we collect, whatever redemption charges we collect, which are short-term redemption charges or any income of whatever nature, is 100% distributed to our investors at the end of every quarter. And that has been the hallmark of our funds, where it's a continuous income generating and income distributing fund. And the two significant nuances from a risk point of view vis-a-vis many situations in the market where funds are either equity focused or late stage or rescue or distressed or whatnot, is that we enter only in brownfield situations where the project is generating cash. And secondly, we have multiple projects that are securing every single investment that we make. So that takes care of a substantial piece of the risk. In addition, obviously, we have both our team as well as third-party agencies who consistently give us monthly, quarterly information on how sales is moving. We do a quarterly cash reconciliation. By the way, every single sale on every single project that is mortgaged to us needs our NOC. So we have folks who are only giving NOCs for 2 reasons. One, validate the sales price at which we have underwritten. So if there's 5,000 rupees a square foot, we need to receive 5,000 rupees a square foot from the customer. The developer can't sell it for 3,000 rupees a square foot and the difference in cash. So that will again trigger off an event of default. The second is the fact that we are constantly abreast of sales and when it happens, and the timing of that sale to when the cash is collected and when it hits our escrow account. So that way it's a pretty actively and intensively monitored business. And it's not just the template that protects the risk, but it is also the post-disbursement monitoring that happens in this fashion. So that way, a lot of the risk, or a significant piece of the portion of the risk, is mitigated through our underwriting philosophy, our underwriting processes, and the post disbursement monitoring.
Sure, Karthik, this I think explains everything. But again, trying to make it more seamless and easy for the audience, for the investors. So
Sure.
we are, talking about real estate backed alternative investment fund in category 2, which comes with a minimum commitment of 1 year. The fund is recently been launched, and there is a track record, by Sundaram Alternates of having 3 such funds already running and absolutely successfully running. And till date, there has been kind of not even a single event of any delayed payment. And obviously, all these products come with, you can say, a targeted return on gross terms of somewhere close to 16 to 18% conservatively, and then obviously net of expenses and taxes, this comes to closer to 9.5 to say 10% in the hands of investors. So that's the kind of product that we are discussing. One risk that we understand in this product, Karthik, is illiquidity risk, which most HNIs and ultra HNI investors accept. Obviously, for the possibility of somewhat linear return, and that comes as form of say quarterly payments and then redemption premiums. And you have mentioned a lot of risk mitigating measures that you take, and we know there is a track record, no eventuality has ever happened in the past. But now if we talk about risks in terms of something which can go wrong, or what worse can happen, or if that worse happens, what investors should expect in that context. So basically, because there are a lot of investors who have large portfolios of having done investments over last 1.5 decade into debt mutual funds. And even debt mutual funds went through credit crisis, especially the credit funds in 2018-19, during which ILFS and DHFL crisis happened. Now, when more and more money would be coming to private credit, there would be obviously something which is yet not known or may happen in future. I'm pretty sure it will not happen in your case, obviously, because you have very high skin in the game. Your own I would say 12 to 16% always gets invested in each fund, is what my understanding is. So obviously that brings a lot of comfort to all of our clients. But given your 22 years of experience, and when you are handling these transactions, most of these questions are around risk, because this particular category brings the foremost question on risk in the minds of investors. So you do a lot of measures, but what can go wrong? So it's like one is an illiquidity risk, which investors understand and expect. But can return go down, or can principal be lost? So what is it that which can go wrong in terms of expectations for the clients?
Okay, no, this is so I always like to answer this question looking you straight in the eye, Kamal, and you and I have had this conversation before. Look, everything has its risk, so nobody is going to pay us 18 to 20% more or low risk, right? But the goal through our underwriting policy and through our underwriting processes seeks to minimize those risks, right? I mean, not do away with those risks. And as I explained, in real estate as a sector, what is the fundamental risk where most investors have lost money, whether they buy property and lose money or they invest in funds and lose money, is because of 2 reasons, right? One is stylistically, you come in very early and you end up taking a significant amount of greenfield execution risk, in which not just involves the developer or the builder, it also involves the ecosystem in which he or she operates, right? I mean, so whether it is that state, it's politics, it's sort of on the ground issues and so on and so forth. So a lot of that is mitigated in our situation because we simply don't come in pre-approvals at all. So I would think that 70 to 80% of the embedded sector execution risk is something we don't do. So the residual risk we take is the guy able to construct within a certain time frame, within a certain cost, and is he able to sell at that price point, right? So from that point of view, we take on and come into projects, as I said, brownfield, where 30 to 40% of construction is already done, 30 to 40% of sales is already done. So we are able to already as part of our diligence, talk to customers, understand price points, where is the velocity, how has it been selling over the past 6 months to a year, and so on. So we are able to reasonably put our finger and say, look, it can sell at 4,000 rupees a square foot. There is sold receivables of 40 crores against a 50 crore loan that I would make, right? So a substantial piece of my loan is already secured by virtue of units and flats already sold, right? So, you're able to take some level of completion risk already as an assessment. So, which is all not possible if you came in very early, because everything is an open risk at that point in time. So, from an execution standpoint, you enter brownfield and at a stage where you're able to reasonably assess, all of these things. That's sort of point number one. The point number two is from a sales side, you're able to also see some visibility in terms of cash, where velocity is and so on and so forth. And if there is lower velocity than what should have been in that place, either we take a call to, sort of add to our security structure, or, we understand the reasons for that and either do or don't do the deal. But the bottom line is that, we have multiple separate, distinct streams of cash flow from different projects. So the idea is that, if you collectively look at all of that, you are, if you have to get back 50 crores of cash plus interest, you're probably at 100 to 125 crores of gross cash flowing through your escrows by virtue of, whatever the guy has already done plus what he's likely to do. So the idea is that there is enough cash within the pool of securities for you to sweep into your thing. Despite all of this, you also look at a situation where you're backing developers who have not had issues of credit history or defaults in the past. There could be delays. I'm not going to look at you and say that in 40 transactions, there have been 0 delays. There have been delays. Obviously, we've gone through such cataclysmic events or such difficult situations where, our whole industry was locked down for a whole year. It is unprecedented in the past. Every HFC, every fund was giving moratorium. Perhaps we were only one of few funds, in my understanding, which did not give any moratorium at all. It was simply because of the fact that we had brownfield and we had multiple streams of cash which were continuing to generate into our escrow. So we felt that, look, as long as cash is there, let's pull it out. But we also focus on mid-priced inventory. So which means our end inventory, will be, sort of priced as a unit or as a plot or as a villa, whatever it is, between 50 lakhs to 1.5 crores. So we don't bet on luxury, premium and stuff like that. The volatility can be high in difficult situations and so on. So we look at, I would say, mid-market priced inventory. So I would say 90% of our end products or projects from our projects, will be priced in this range. So effectively, we believe that there is, again, at that level also, a certain mitigation in terms of, what can be the impact or volatility on account of, difficult markets due to whatever reason. And consequently, what is the affordability as well for a customer, who is looking to buy his or her first home? What is the capability to buy a second home? If there is an upgrade from a 2 to 3 BHK or a 3 to 4 BHK, which is the massive trend post-COVID, what is the sort of price point even on a 4 BHK, in Bangalore, Chennai or Hyderabad? So we look into, not just the underwriting or the credit metrics, but also the underlying sort of project. And we hold anywhere between, if we are writing deals at 2 times cover, which means, we're already at a 50% loan to value or lower, right? So effectively, there is so much juice left in each of the projects that, we finance that, even if the customer or the builder has to take some cut in terms of sales price and so on, there is enough LTV left in the deal or enough cover left in the deal, for us to be having a surplus on that particular transaction. I noticed a question somewhere that how much, do we lend against and so on. So it's not just, it's a question of assessment of the builder from a risk point of view, and the execution of the project, the security structure of the deal, the situation in which you enter, the underlying inventory and how it is priced, that particular micro market, and its sort of fluctuations and where have prices moved. Considering that, what kind of inventory are you looking at, stage of project of entry, right? And how much residual period is left. If you're doing a 4-year loan, most of our projects will have between 2.5 to 3.5 years left as a residual maturity in that project. I think that was a question also that appeared. So a lot of thinking has gone into creating this underwriting policy to make sure that as part of our underwriting itself, a majority of the risks are mitigated and covered. And beyond that, obviously, we have to look at who we are lending to, what has been their position in the recent past. Are they politically affiliated? This particular project, has it been selling or not? And we've said a lot of no's. Roughly, by way of conversion, to your point of risk management, we've done 1 out of 10 deals that we've seen, right from our fund one now, right? So if we've done 40 deals, which means that we have looked at 400 transactions. So we have a 10% strike rate, right? So every single deal has actually, every single fund has actually looked at a minimum of 4,000 to 5,000 crores of transactions before it has zeroed in on 500 crores, right? So the idea is to continue to do the same and not actually go into, higher risk sort of situations like very early, very late stage, try and come in, like some of like a Swami fund, which is a brilliant strategy by the government, where they come in and do pure completion on distressed projects. So our idea is not to go into any of that. Our idea is to continuously back guys who are generating, who are delivering, who customer recall, who are in this mid-priced inventory, who are continuously in need of growth financing, to be able to, do this. And by the way, real estate is a sector where one would think that, if a project has gone into delay once, the promoter or the builder would know better and, try and avoid that situation the next time. It's not as though they don't avoid it. I mean, they do their best, but the situation is such that by the time the project is land is purchased, it goes through its approvals, that ecosystem remains the same. That doesn't change. So the opportunity creation for us to do deals like this happens all the time cyclically through systemic issues in the sector. The fact is that we don't see those problem creating situations. We come in after. So, but the generation of transactions for our fund to be able to do these trades, and I noticed a question, if everything is okay, why would a guy borrow at 18%? Why is he giving you 2 projects? He's giving us 2 projects simply because it's not easy. We are executing this not in conformance with what is considered as standard practice in the market, because people see that we're able to move fast as long as it fits into Sundaram's sort of credit metrics. Money can come from them fast. They will be partnerly, they will be proactive, and they will constantly, see, there are further ways to finance me. So I have, today we have one of the, tier 1 builders, just before this conversation, I was on a 1-hour negotiation with them, where we are probably the only lender who is not on their balance sheet, and they can probably borrow money from anybody else. But, they actually come to us and they're saying that we want to open an account with you and see, okay, now how do we deal with you? Because we want to develop you as one of the options that we have. This is a pretty big developer out of Bangalore. So the idea is that we've established some recall where, we are associated with being partnerly, and we move quickly and are responsive to situations, whether it's on the upside or on the downside. So that way, I think there is some credibility and franchise that has been built, but it has taken an effort for us to build. So investors today, looking at our Fund 4, have not seen the doubt and confusion and questions that I had to face in our Fund 1. So, we've gone through all of this and reached a stage where, this has become more of a boilerplate. And this is the only way we think that, we can purely stick to a credit sort of deal, because otherwise, this would be NCDs, but, you could end up taking equity risks, you could end up taking late stage risks, and you could end up taking risk which may not have, mitigations within that particular project, right? I mean, it could be leaps of faith and so on. So, we are not a REIT, we are an AIF category 2 fund. And so from that perspective, REITs typically, I notice a lot of questions on InvITs and REITs. So REITs and InvITs usually target income yielding or annuity type assets, which are typically commercial buildings, ITCs, and so on, which have long-term, large, lease, rent income, which are then securitized and, units are listed in the market. So we are not that, private credit funds in the AIF category 2 format bet on self-liquidating residential projects in our focus geographies of the South. And we found a template to be able to mitigate risks, as I mentioned, and be able to profitably lend at between 18 and 20. So that's sort of, who we are. So some of our competitors are so many funds and so many different investing styles and so many nuances within the underlying asset classes. The investor really has a choice. Do I want to make a 20-21% return, in which case, I have to take some level of equity risk. We are saying that, we are, at an 18%, 17-18, because we think, considering all the security structure and the risk mitigation we do, 18 is a fantastic risk-adjusted return for us to get from an underlying asset, right? So this is also a closed-ended fund. So I noticed a question from Shailesh saying, CAGR since inception. So this is not an open-ended fund for the last 6 years. So this is our 4th fund. Fund 1 we raised in 2017-18, which we returned last year. We generated a 15.2% return in the hands of investors gross. Fund 2 we raised in Feb 21, which is already through its investment cycle and harvesting return. That's currently running at YTM of close to 17%, NAV wise marked. We do have independent valuers, who are between Cushman and CBRE, who do our independent valuations. We report to investors every quarter on our entire portfolio, even fund level information. We have annual independent valuations that measure at where we mark the positions, where the security value and cover is, and so on. So all of those governance things, we do. This is a 5-year fund, so the lock-in is 5 years. But as I said, every quarter we distribute income in terms of interest and as well as fees. So I would say, on an average, from cash in to cash out perspective, on a 5-year fund, by let's say 3.5 to 4 years, you're 100% out, and the last 1.5 years is spent building multiple, on that fund from an IRR perspective. So essentially, this is sort of how the funds are structured, and how we like to approach it from an investor perspective. So what has changed in the last 2 years? I'm going to make an effort to just try and go through some of these questions. I'm very happy to see a lot of these questions, but I'm going to try.
One of the questions which should be addressed foremost is that when the gross CAGR is expected to be somewhere close to 16 to 18%, how does the net CAGR comes to around 9 to 10%?
Yeah, so net CAGR of 9 to 10% is really post-tax. We really don't comment post-tax. So what we do is that the way the waterfall works is that at a portfolio level, we try and generate 18 to 19%. From there, there is fee structure, which is a combination of annual asset management fee, which is typically ranging between 1 and 2%, depending on the amount of capital you contribute. 1 to 5 crores, is 2%, 5 to 10 crores is 1.75, and then 10 to 25 is 1.5, and then it goes all down to 1% if you do 25 crores and above. And then there is OPEX, which is really fund running costs, RTA, audit fees, and so on and so forth, which is another max cap 0.5. And then there is a back-ended profit sharing beyond a hurdle rate of 12%. Beyond 12% hurdle rate is something that we get paid at the end of the fund after we generate post-fee returns greater than 12%, only to the extent of the difference. So we don't charge with catch-up. We have a without catch-up clause. So the idea is that if you add everything, so even a 2% sort of person who pays 2% annual asset management fee, will end up paying roughly between 3 to 3.5. So if you are at 18% at the portfolio level, you are at 14.5 post fee, everything, right? So, and you lose, let's say, 1 point on I won't say delinquencies, but more on treasury, where we draw down cash, we hold on to it in liquids for some period of time till we make those investments. Obviously, we try our best to minimize and increase that efficiency, but that's why we sort of target between 13 and 14 sort of post fee pre-tax sort of return. So our investors range between individuals who end up paying maximum marginal rate 40%. So if you have a 13% at 40% tax rate, that usually comes down to about 8.5-ish sort of post tax return. And then you have a lot of family offices and even large individual investors invest through company structures, where the tax rate is 25%, as I understand. I don't want to be a tax expert here, but it's 25%. And so obviously that 8.5 will go to closer to 9.5, 10, for persons who invest out of company structures. So that's how the waterfall works. So even in this context, on a senior secured, well diversified basis, where we can't do more than 10% of the fund in any single deal, so there are 10 to 12 deals. So in a diversified portfolio, senior secured, consistent cash paying, senior sort of cash flow generating with all the risk mitigation, this sort of return has been fairly appealing especially since we've been consistently able to generate this over a period of time, and particularly over a difficult vintage, which is why there is a lot of interest in investing into this particular asset class. And so we found a way perhaps to look at an investment that is perceived as risky, but we've gone and structured it and credit enhanced it in a way that it is actually more comparable to a typical corporate credit bond, where even in a corporate credit bond, if you take the entire universe of 160 to 200 bonds that are private and obviously traded in the market actively these days, whether it's if it's a AAA bond, it's ranging between 7 to 8%. If it's a AA or A bond, it ranges between 8 and 10%. And then you have triple B, and then going all the way down to sub-investment grade, which can go up to 13, 14. But these are all gross returns. single exposure, unsecured bonds, and really, other than sort of the IBC, NCLT, where you still need majority of your investor in syndicate group to go in. Here you're playing the same strategy through a fund that is diversified like this and credit enhanced like this, where on a comparable basis you're making a pre-tax equivalent to a gross return on any of these funds, right? I mean, so 13 to 14 pre-tax is significantly, in our opinion, 300 to 400 basis points higher than any of these comparable structures from a risk point of view. So that's the way we are looking at it. So I thought I should mention that.
Sure, Karthik. I think you explained brilliantly. I'll just request you to kindly now give crisp answers, because we have to cover 4 or 5 more questions, and we
Sure.
have 10 minutes left, right?
Sure.
So if an investor has to select between your Sundaram's Eco Fund and this real estate fund, are there any factors that one needs to keep in mind in terms of risk return expectations while doing this selection?
So two different sectors. Obviously, corporate credit is sector agnostic and more diversified in terms of multiple sector exposure, versus this is a real estate sector. So that's really a choice. But the returns we are targeting are comparable, where even on the corporate credit or the eco fund, we are targeting 17, 18 gross and 13, 14 post fee returns. So from that point of view, we are packaging risks in both fund offerings in a similar fashion, where we are mitigating risks and creating fairly competitive returns. So it is more a preference we've seen from investor feedback, that somebody likes real estate and they go in for this fund, and somebody says, I don't like real estate and let me go in for a more diversified fund. But other than that, we are not trying to configure things differently, because in real estate, people in theory could make much larger returns, but then they have to take much larger risks as well, that on a single sector risk and exposure, and it goes into a different bucket of risk.
I know in case of Echo, where you already raised substantial amount of capital, the parent company, your parent company, has also put in substantial money, close to 15%. What are the plans and what are the targets with regards to this real estate fund?
It's similar. So all our funds have between 15 and 20% sponsor contribution, and some funds even higher. So this is again definitely a USP in the market, where we find a lot of sponsor contributions to be south of 5%, and in most cases between 5 and 10. So we are clearly having more skin in the game from our sponsor, where Sundaram Finance is committing to between 15 and 20% in all the funds. So that comes out of deep conviction, and not just the fact that they've done it in the past. So they actually believe this is very sustainable as a return metric, and so they're quite happy to actually sponsor each of the funds.
So, there is this recent new thing that SEBI has started, whereby if an HNI is able to get certificate of accredited investor by showing certain net worth or certain annual income, then that investor can invest in AIFs with less than 1 crore ticket size also. So those investors or those clients who have got that in their favor from SEBI, can they invest in this fund with less than 1 crore?
I'm not exactly sure. I shouldn't shoot my mouth off there, but I understand the accredited investors are more beneficial in terms of the investment managers. So, for example, one accredited investor can comprise the entire fund, and you don't need to have a minimum of 2 investors. So it actually is more flexibility for the investment manager, and obviously for the investor, there is an ability to look at differential classes and have differential rights. But having said that, I don't believe, but I can come back to you on this, if the investment limit is less than 1 crore. So I think that continues to remain a crore.
Sure. So does this fund also accept NRI money from all residencies, or there are certain restrictions?
So NRI in general is allowed as a concept, although we are not able to market our funds from to the US and parts of Canada and North America and so on, because of certain regulatory guidelines. But investors offshore can invest through their NRE and NRO accounts as NRIs.
And can foreign nationals also invest in foreign currency in this fund?
Yes, but effectively, the end of the day, the exposure in the fund is a rupee exposure. So even if they put money in dollars, it actually gets converted to rupees, and they end up going long on the rupee. So that is a risk that they have to take on the currency. We don't offer cross-currency swaps and hedges and so on, except in the case of institutional investors. We did have a Mauritius feeder fund, And we may set up in the future gift funds, where people can come in and those act as feeder funds where they can invest and go out in dollars. But right now, dollar investments to master is absolutely possible, but it gets converted to rupees.
Sure. So to audience out here, I'll just quite quickly give a brief of whatever we have discussed. There is this real estate backed alternative investment fund, which is the fourth fund launched by Sundaram Alternates. And broadly speaking, this is fund meant for those investors who are looking for linear return, to be filled in their debt part of the portfolio. This fund comes with a time horizon of say 5 to 6 years. It has an illiquidity risk involved, but it gives linear returns in terms of quarterly payouts. And obviously, because the asset is real estate, it is collateralized, it has theoretical credit risk, but obviously, the risk is being managed quite well, and that is what is kind of understood by the entire discussion as well as the track record. And the sponsorship commitment also adds comfort to that. Now, one another aspect, which we should be covering, I think, as a last question, Karthik, is some of the flavor of the type of, I would say, developers. Because I sitting in Delhi and a lot of our clients in Delhi have this understanding that developers in northern India are somewhat less credible, and maybe in southern India we are not too much aware. It's a perception that there the credibility is relatively higher. But what is the target universe in terms of maybe few examples of some of the older developers, if you can give? Because as we talk about any equity portfolio, we talk about certain companies. Similarly, in this portfolio, if you're able to talk about some of the older companies or some of the new companies that you're looking for, that will give some context to the discussion.
Okay, I'm happy to give it, but I've had conversations not just in Delhi but in Mumbai as well. And honestly, real estate is a very regional business, and to that extent, I think many of the names that I may mention now may find zero recall with people in this audience. But just to give a flavor of some of the names, we've lent in Chennai to Sumant, which is a very long-standing 25-year developer. We've lent to Lancor, which is a very established and credible name. In fact, it's a listed company. But on all our underlying projects are we're getting prepaid. In Hyderabad, we've lent to guys like Vasavi, who's a very large developer. We've lent to Concept Ambience, who's got at this point in time, I think more than 4 million square feet under development. In Bangalore, we've lent to Concord, which is a very strong developer in various micro markets of Bangalore. We've lent to suddenly I'm just blanking out of the names, but these are some of the names that we are looking at. Where I would say as a category of developer, all the guys we tend to have at any point in time between 6 to 8 projects running. They will have gross sales, between any of all those projects at between 400 to 500 crores. They will have 0 defaults in the past. They will have a track record of having serviced capital and lenders and financiers in the past. They will be mid-priced inventory of roughly around a crore, 0.2 in terms of units. We will typically be 30 to 40% of the size of their overall cost of their projects. So there'll be plenty of subordinated equity value below us. I would say, what else can I give you as metrics? So we won't be lending to the Prestiges and the bids and the embassies of the world. These are not guys who will borrow from us. I mean, these are guys who have access to multiple forms of financing. Mutual funds, for example, are willing to lend them money for land acquisitions at 10% to Prestige, for example, right? So those are not our target. So our target are guys who are deemed as tier 2 or cat B, whatever name that CBRE or JLL or ANAROC calls them. But these are cat B or tier 2 only by reason of being smaller than the Prestiges and Brigades of the world, or the Vicky Oberoys of the world. Or I'm hesitant to take a name in the north, because any name I take has a tinge to it. But these would be pretty they won't be the AIFs of the world, right? And so effectively these would be, but these would be solid guys who consistently got financing in the past, who have an ability to hit 400-500 crores of sort of sales on every single project that they do, or a series of projects or basket of projects that they have. So to that extent, very sustainable, growth oriented, and very strong brand call their local micro markets. In fact, in our pitch documents, if any investor is keen, it will have breakouts of these guys. And And obviously, when there is active interest from anybody, we can share even our newsletters which have actual names in it as well. So, we'd be quite happy to do that, at that particular point.
Sure, thank you, Karthik. So, to one of the questions of audience, what is the annual expected cash flow? This is on gross terms, I think indicatively around 10%. Karthik will kind of add to
Yeah, I think
this.
post fee, yeah, it would be around 10%. You're right. And that compounds. And so effectively, that 13, 14 net of fee is a result of compounding of that, 11, 12. And the fact that we also reinvest the principal portion of what we get back and try to do 1.5 turns of capital. So your capital, for every rupee I get, I actually try and do 1.5 to 2 rupees of business. So effectively, you earn twice on the same amount of capital. So the benefit of that with compounding will give rise to that CAGR. We have a quarterly repayment schedule, a quarterly income distribution schedule, and from sort of halfway through the fund tenor onwards, we will start distributing capital. So it would be good to assume that in a 5-year fund, between 4 to 4.5 years, you should get all your money back. In fact, in Fund 2, as an example, in Real Estate Fund 2, which we closed, as I said, in February 2021, we are now sitting at 2023 June. It's 2.5 years into the fund, but from the next quarter onwards, or from December onwards, we're going to be distributing, a significant capital back, simply because we find that it's better to return capital rather than try and do shorter term deals which increase the risk. So that would be roughly the scheduled estimation of cash.
Sure. Over last, couple of years, especially after COVID, the demand on real estate has actually gone up substantially, and that kind of makes real estate sector kind of more attractive. Why is it that in the current context, when real estate sector is already attractive, you will be able to find many kind of credible buyers at this stage? And is this kind of a risk that over, say, life of the fund, will you be able to kind of keep kind of finding such borrowers over, say, next 4 years, which is the first 4-year period where you'll be kind of investing the investor capital?
So the same question was asked to me in 2017 when I launched Fund 1. We're sitting 6 years from them, with the same questions. So I would argue at that point in time that the industry was going through a lot more strife and difficulty with actually low demand for real estate. So now we believe that since demand is picked up and the industry has entered a growth phase, we will have a lot of demand for capital going forward. So we think this is fairly sustainable. But obviously, the orientation of end use, etc., has changed, from let's say 2018-19 to date. But having said that, the industry is in a very good phase right now. So we anticipate that there will be new launches. There will be more discipline post RERA in terms of delivery, and so that inventory build up, the number of crashes, the number of projects that actually don't see light of day, the fact that India says you can start only after all approvals. So there's a lot of corporatization and governance that has come into the sector post the implementation of RERA in 2018. So that is massively helping corporatize the sector in more transparency and more customer rights and so on, even in IBC and NCLT. So from that point of view, the industry is definitely growing, but growing in a more organized and disciplined way. So we definitely think that the opportunities are likely to stay, if not grow. We're not an equity fund, so we don't bet on future NAVs and so on and so forth. So, but what we do know is that there is demand for capital, and as long as there is demand for capital, and the fact that this is a regulatory arbitrage business where we can charge premiums for liquidity for end users that banks cannot finance, I think this is a very, very sustainable business and enough for a lot of funds to participate.
Sure, I'll take 2 more questions if you have 10 more minutes. Karthik?
Yeah, I'm okay. Please.
Sure. So, there is one very interesting question asked by someone over chat. I was reading that if I have substantial allocation to already real estate, physical real estate, would it be prudent to invest into a fund like this?
So this is a very, I've had intense debates with customers, to put it politely, on this particular point, because in 2017, especially when I went to pitch in a place like Mumbai, where I'm a part Mumbaikar myself, I spent 16 years there. But people were saying, I'd rather go buy an apartment in Juhu JVPD scheme rather than put money in your fund. So if you see, the answer to the question is very simple. If you see the capital appreciation uh, from now, or based on what you are able to sell your existing real estate at today to what it can be 5 years from now, I think you will find our own view is that it's going to be less than 10% on a compounded basis. So as long as you are able to make capital appreciation beyond a CAGR of what we are delivering from the fund, it makes sense for you to actually go heavy onto physical real estate. Otherwise, it makes absolute sense to sell your physical real estate and reallocate to fiscal real estate, which is really what this fund is. This fund is all about creating that kind of IRR and compounded returns, which between 2000 and 2012, for example, physical real estate was delivering, and I myself was a big buyer of physical real estate. But I find that over the last decade, funds have actually delivered more than what physical real estate is. But of course, different people have different views, and obviously, this is not a generic answer. I mean, if you have something in a fast-growing area where like Gurgaon in 2000, things will be very, very different, right? I mean, but how many such opportunities does one see today, right? And so sitting today, I mean, if you've already had 15-20% growth from a CAGR perspective, I personally would think that rather than trying to find some piece of land that can grow at that pace, it's far easier. But of course, you have to take a bet in terms of putting money with a guy who's consistently able to deliver that return. Otherwise, you much rather hold on to that land and sit on that capital value. So it becomes capital preservation rather than capital growth. So that's really the sort of parameters that you have to ponder. But I've seen the gentleman who incidentally had this argument with me in 2017 is a big investor in our funds since. So he since sold his JVPD flat and put money in our fund. So from that point of view, I can just give you anecdotally.
Sure. So to this last question, since this is a fourth fund, and every time when a new fund is launched, there are certain learnings from the past fund which are implemented. So obviously, if there are any learnings or any, I would say, add-ons, so that are there in this fund which were not there in first three funds, would you want to throw some light on those?
So there are 100% there have been learnings, no doubt about it. But there isn't anything that we haven't already executed and implemented in our earlier funds that is unique to Fund 4. But having said that, some of our learnings has been that, for example, in Hyderabad, where it is a micro market that is belying all logic and growing incredibly, over the last 5-6 years. I have never seen in my personal experience a market like that. So every time I feel that it's going to crash and it's overburnt, it's actually selling some more. So what we decided to do, since we couldn't sort of second guess that market, is we said that okay, let's move all transactions on a sold receivables basis. What that means is, in addition to hard assets, in addition to multiple projects and everything else that I said, for every 50 crores we disburse, we need 50 crores of sold receivables in that particular market. So which means that even if it suddenly crashes and burns, as long as I'm able to complete the inventory that is already sold, I get my money back. So we've made those sort of particular micro market oriented nuances. Bangalore, we moved from apartments to plotted, because velocity is faster. So like that, we keep making shifts. The other big learning that we have is on treasury, which has nothing to do with credit, but on fund treasury, where we felt that we should draw down in tranches where we can actually deploy. But obviously, we went through the first two funds at least in a period of extreme turmoil, where we drew down, and in promoters were sitting in ICU with COVID. So I actually took a call and said, we're not going to disburse, even though everything is okay. We've signed documents, we have the money drawn down. I'd rather sit on cash and in liquids and not generate that return rather than lose the capital. Because if the guy passes away, then God forbid, we have a serious problem. So, things like that, I think we learned, and we said that, okay, let's temper the pace at which we draw down money and really aggregate money and reduce that drag on idle cash. So that's a big learning for us. In our fund one, we lost a lot of return only on account of treasury leakage and not on account of credit. So the third is obviously due diligence findings, which I don't want to go into in great detail now, but certain things which we earlier on didn't do, but that we corrected even in our fund one. We started doing in terms of not relying on certain pieces of security and not looking at JDA partner comforts and so on. So the security structure modifications we've learned over time that certain things work, certain things don't work. but the business is built around positive incentivization to pay us back rather than negative disincentivization, to pay us back. That's a big difference between the two. So one is I'm forcing a guy to pay me, and the other is that he wants to pay me. So I'd rather do the latter, where I said I have a wide enough security basket, I have a high enough return, that guy has more to lose than me if he defaults. So the faster he pays me, the better off it is for him. So that's what has largely worked in our business, and we will continue with that.
Sure, Karthik. I think this was quite insightful session, and thank you everyone for logging in. There are many questions which I think still are unanswered, mostly around taxation.
Yeah.
Unfortunately,
And to last question to Mr. Ravichandran's point is that our fundraising will stretch for about 8 months, so you have time to enter. It's not as though you have to commit right away. It's not only at launch; you have time.
Thank you so much. So I see not all questions are answered. That is why I have just created this offer for the audience to book calls with us. You are most welcome to book appointment with us. We have in-depth understanding of the entire space. There are many products in this category, and because at present interest rates are high, and also real estate sector has actually become more robust in terms of regulations around it. This is actually a good opportunity to explore, and maybe if you like and if you find this suitable to your asset allocation, to your risk appetite, a good opportunity to invest. And credible players like Sundaram, who have been learning over years, bring such credible track record. And obviously in this space where risk matters a lot, that is where we are doing this detailed webinar with Sundaram on this particular product. So my apologies to any question if we have missed. I think we may have missed questions on taxation, which deliberately I have not asked, because we are not tax experts. For that, we can do one-on-one conversation, or you can talk to your tax advisor. But particularly on product, we have covered everything, and thank you so much, Karthik, for covering
Pleasure.
Almost every aspect. To any question which is still unanswered, I welcome you all to book appointments with us. We'll be happy to take those one-on-one. Thank you, everyone. Have a nice weekend. It was a pleasure connecting.
Thank you so much, Kamal. Really appreciate it.